Today we have with us Mr. Chintan Haria, who is the head of product and strategy for ICICI Prudential
It's too
AMC.
late before we realize the importance of investing.
Complete world has been facing inflation, and now it has reached certain moderation or seems to be cooling off.
Invest for as long as you can. Find opportunities and create portfolios so that you benefit out of the opportunities in the market. Whenever there is an aggressive player on one side, there has to be a defensive player on the other side.
Hello everyone, today I'd like to welcome you all on behalf of Bajaj Finance Limited for another exciting session on the topic, the art of creating your own bonus with mutual funds. We all have worked very hard to earn our annual bonuses, and most of us have apprehensions, doubts, questions as to what to do with this money. Well, I would recommend it's always a smart move to invest this money for wealth creation rather than keeping it in your bank accounts or spending it. So, to help our viewers with all the questions that they have and to make wise investment decisions, today we have with us Mr. Chintan Haria, who is the head of product and strategy for ICICI Prudential AMC. Mr. Chintan Haria, thank you for joining us. Mr. Chintan Haria has an rich experience of around 18 years in mutual fund industry. Mr. Chintan Haria has successfully managed portfolios for ICICI Prudential Arbitrage Fund, Long-Term Equity Fund, Child Care Fund, and Equity Savings Fund. His core competencies include research, portfolio management, market intelligence, and strategic asset allocation for investors' wealth creation, and creating innovative products to help investors. Mr. Chantanaria has a master's in commerce and is a chartered accountant. Without wasting much time, I'd like to hand over the stage to Mr. Chintan so that he can help our viewers make wise decisions and create more wealth with their hard earned bonus. Sir.
Thanks, Rohan, and thank you to Bajaj Finance and the Bajaj Group for allowing us to interact with all of you. If we look at the last 18 years, one thing that I have learned is that while people spend a lot of time in their profession and their work in trying to earn money, trying to do well, trying to get a good rating, trying to obviously make a good bonus, the one thing which most of us falter, and the reason is not us or the reason is not our fault, we are not taught how to make money out of money, right? In schools, we are not taught how to invest. In colleges, probably we are not taught how to invest, and we learn as we earn. And that is where probably many of us find it that it is too late before we realize the importance of investing and making money out of the money that we've earned. So the topic of discussion today, making a bonus out of your bonus, is very relevant. And if we look at how you can do that, let's just go step by step in terms of the core. If you are having money, you need to invest that money. Like Rohan mentioned, very easy these days to spend that money. Most of the youngsters or most of us feel that okay, we should have the latest gadgets and cars and we the latest fashion statements. That obviously is expenditure, and that is not going to help you create wealth. To some extent, of course, spending on what we like is good, but if you invest today, then probably you will have a good future. So saving is also a good virtue, and I think as Indians, we've been passed on that legacy of savings by our ancestors, and that is where India today is in a very strong space, where neither the government has borrowed too much, neither the individuals like you and me have borrowed too much, and the corporates are also in a good shape because they've also deleveraged or they've reduced their borrowing. So the reason why India is shining, it is the fifth largest economy moving towards probably the third largest economy in the next 6 7 years or so, is the fact that we not only work hard, we know the virtue of saving. And one of the aspects of saving is the right way to invest. So let's look at the options that you have in terms of investment. The easiest option is that you allow, with the right advisor, of course, to invest in mutual funds. When you invest in mutual funds, you get the expertise, the professional expertise of investing in the right sectors, stocks, in the right debt papers, and also in gold and silver. And the choice is then that you have in terms of financial investment in mutual funds are quite wide. Let's understand one thing, that it is very important to invest in the right manner. And I will also explain what probably is a good portfolio allocation for a good wealth creation in the long run. The basic principles that you must follow are very simple. One, invest for as long as you can. The virtue of patience is extremely important. It is less understood, or it is probably misunderstood, that who will invest for a long time is the power of compounding for real. But only those who actually invested and stayed invested for long understand the power of compounding and wealth creation. So start early, start saving early and investing early, and you will get the benefit of long term investing. So, the rule number one, the longer you invest, the better. Second, rule number two, do not invest in latest trends, latest fashions, latest whatever you feel is given a lot of return in the recent past. Whenever you invest in something which has gone up too sharply in the last 1 year, 2 year, 3 year, you run the risk of basically losing your capital, because the sector or the stocks which you would probably invest in can actually go through a downward cycle as well. So the important aspect is that you should not follow trend, you should not follow what is called a herd mentality, and something which has given exceptional returns or high returns in the recent past. You need to be very careful in investing in that. Third, and the most important, as I see, is asset allocation. What is asset allocation? Asset allocation is essentially having the right mix of equity, debt, gold, silver, real estate in your overall portfolio. Now, real estate as an investment class, because of REITs becoming popular and InvITs also becoming popular, real estate as an investment class is picking up in India. But generally, it is essentially about equity, debt, gold, uh, and maybe now silver ETFs are also available. So, silver from an investor standpoint of view in financial markets. Equities is least understood. What one we must understand is that the asset class which beats inflation in the long run is equities. And why is it so? Because ultimately, the goods and services which you buy from the companies which are listed on the market, those goods and services get expensive, and the companies which are providing us with goods and services are able to charge us higher in inflationary times, and they make their profits, and ultimately that leads to the return in those companies. So if you look at the past history, equities as an asset class is an important asset class, but Indians in general have not been investing in equities in a very large manner. If you look at the statistics, I think the March 2022 statistics which I saw, out of the 800 lakh crores of savings that India has, that is your saving and my saving put together, only about 5 or 6% of that is in equities. A majority of that is in real estate, gold, fixed income, which is good because at least the savings are generating some return in the form of fixed income or gold or real estate for those who are investing there. But equities as an asset class is only 5 to 6%. With the government's push in the last 6 7 years to allow EPFO to invest in equities, that's a good trend, because a large number of people who are contributing to EPFO are getting indirectly invested in equities through the EPFO investments in equities, which is a good trend. It is positive because that is real long term money. And the advantages of investing in equities for the long term will be basically got to the employees who are contributing to the Provident Fund Trust. As far as equity investing in India is concerned, because people don't understand equities well, people don't understand what are the drivers of equity well, they probably end up losing money in equities, because everyone feels that I should invest today in equities, make money tomorrow, and then get out. People do not understand that equities is a long term perennial asset class. And if you invest in a sensible manner, that's the asset class which generally will be able to create wealth for you in the long run. History has proven it, and probably future also, while none of us can predict exactly what will happen. If India has to move from $3 trillion to $5 trillion, the goods and services sold by the corporates in India are also going to go up. And when goods and services sold by the corporates in India, which are listed, will go up, probably their market caps will also follow. And that's where the wealth will be created for all of you if you are invested smartly in equities. So, what does asset allocation mean? That's the third rule. Like I said, follow asset allocation. Um, what what I have noticed in my hundreds of interactions over the last 7 years in this role is that investors don't necessarily have the right advisor for their financial assets. We all have family doctors, but family financial advisor is missing for many individuals, and that is something which you must have, because you may not have the time to follow so many moving parts which are happening in the economic world, and the financial world. So having a right financial advisor will help you to invest in the right places to ultimately create wealth. And that's what asset allocation plans, which the financial advisor can create for you, will help you to do. If you look at the overall asset allocation plan, it will have some equity, some debt, some gold. And how much equity, how much debt, and how much gold will generally be decided by each individual factors. Now, no two individuals are alike. Even if they are twin brothers or twin sisters, their actual individual circumstances can be different. So asset allocation can be different for each individual, even if they are twins. But in general, if we look at it, having a 30 to 40% allocation to equity, having a 10% allocation to gold, and probably having the rest in fixed income is what generally people follow. What I believe is, as part of your asset allocation, you could think of the following, and I'll explain why. You could have a large allocation. Now, if I mean, in general, I like cricket a lot, and in terms of cricketing analogy, if you have to see, whenever there is a aggressive player on one side, there has to be a defensive player on the other side for that particular team to do well, because the defensive player at all points of time will ensure that the aggressive player is able to freely score while the defensive player holds one end. And that's what essentially the long term partnerships, if you look at the most successful teams, has always had. There's always one rock, one wall, one person who's heading the defensive pack and a strongly holding one end. And from a asset allocation standpoint, that job is done by the dynamic asset allocation funds or the balance advantage fund category. So the first aspect of making bonus out of bonus is, don't allow your money to lie idle in bank. The moment you get bonus, irrespective of what time of the year, what valuations of markets, whether markets are high or low, you can park a sizable sum of it into the balance advantage fund category or the dynamic asset allocation category. I'll explain what this category does in the Q&A, which Rohan will do. But basically, to start with, rule number one, rule number three essentially is about asset allocation, and a core of asset allocation is the dynamic asset allocation bucket or the balance advantage fund category. So a large part of your money can go there in balance advantage fund, which will invest in equity, in debt, in a sensible manner based on market valuations. Will keep maneuvering it, and ultimately over the long run you'll have benefit. This is long term allocation. Then some money you can put in gold and silver depending on what cycle gold and silver is going through. Many people are investing in international funds as well, although today I don't recommend international funds as such because of the lack of visibility on what's exactly going to happen abroad, because there's a recession, crowds are rooming. But yeah, international is one aspect which you can look at. But the core, like I said, the defensive pack or the stable pack is the balance advantage fund category and the dynamic asset allocation category. To start your investing journey, if you really don't know what funds do, the balance advantage fund is the first fund of choice which you should invest in and learn about investing. Second is in terms of allocation to debt. Now, again, debt is something which most of us don't understand. Debt is something which most of us don't probably appreciate. But then debt plays its own strong role in terms of giving that strength to the portfolio and stability to the portfolio. In balance advantage fund category, you have debt inbuilt into the category. And through a good mixture of debt and arbitrage, you will get the right allocation. So as high as 50%, and for most investors, even if you want to go 80 to 90% of your disposable income which you have to invest for the long run, you can have in the balance advantage fund category. Apart from that, of course, you can have SIPs, which is systematic investment plans, in flexi cap category, multi cap category, mid cap funds, small cap funds, and allow those SIPs to grow over a period of time. As you would have seen and heard, SIP is like a miracle which most people are probably following right now in terms of investing, because what it does is you save every month, or rather you earn every month, you save every month, and you invest every month, drip by bit, little by little, over a period of time, you collect units. And most investors have seen the advantages of this investment via SIP. Now, systematic investment plans are something which you could look at in terms of fully invested funds in the flexi cap category, the value category, the mid cap category, the small cap category. So, for lump sum investments, I would recommend generally for most investors the balance advantage fund category, and you have to have SIPs in these categories. Now, the beauty about mutual funds is they provide the opportunity to participate in sectors in India also which are which have grown in the last 20 years can grow in the next 20 years as well. So if you look at pharmaceutical as a sector, right? Pharmaceutical sector, we all know that the number of medicines of which we are going to consume as one of the most populous countries. We are 141 crore people, going up to probably 160 crore people in 2050. We are going to consume more medicines. And so the pharmaceutical sector, the hospital sector, the healthcare sector becomes a good choice. So you have sectoral funds also where you can start your SIPs. These are generally more risky, generally more volatile. But if you pick the right sector like pharma, which has a long term growth story which is intact, and start participating in it, then you can take the advantage. As you all know, India is not only the world's highest information technology or tech outsourcing country, it is also one of the largest in terms of pharma outsourcing. And we are strongly growing in auto and electronics also. In defense, also last year we exported 15,000 crores. So if you look at the overall growth of India, there are so many sectors, so many themes which are opening up. It makes India a very attractive destination for equity investing because there are so many sectors, so many stocks that a fund manager can select. Now the mood question is, why can't you do it yourself versus giving the investment in mutual fund? If you're investing yourself, you'll have to follow so many variables that are happening. What is the company doing? What is the management doing? Is the industry in which the company doing which is right? But if you invest in a mutual fund, there is an entire ecosystem in a mutual fund which is basically doing its job to earn bonus out of your bonus, to basically participate in the market in the right manner. You essentially have the chief investment officer, one of the most experienced members of the investment team, leading a team of senior fund managers, junior fund managers, senior analysts, junior analysts. And these well trained research investment team basically do the job of 24 by 7 focusing on how they can basically find opportunities and create portfolios so that you benefit out of the opportunities in the market while they'll also take care of the risks of diversification, etc. So what you get in a mutual fund is, generally, if you invest in a mutual fund, a diversified set of stocks which are well researched, which are well picked up, and as far as investment is concerned or the research analysts are concerned, their only focus is on this particular job. They are not doing any other job, they are not focusing on any other things. And so it becomes a specialized approach towards investing. All of that, of course, is available for a fee, which is again regulated by the regulator. And so you get the advantage of having professionals pick up stocks, sectors, and create portfolios for you. Probably it is less appreciated, the impact of having professional investment for you. But then the fact that mutual funds today are more than 8% of the market cap of India versus being less than 1% of the market cap of India in 2008. So in 15 years, from being less than 1% to being more than 8%, it is a testament to the fact that mutual funds are being trusted by the investors to basically get exposure to the right sectors, right stocks. Even in debt, if you look at it, mutual funds are able to pick the right set of debt instruments so that as a mixture, when you invest in the balance advantage fund, you will basically get the in that category the advantage of equity in debt. Now, as far as gold is concerned, that's also an asset class which helps investors in uncertain times. We've seen in the last 6 months gold and silver both go up. Both gold and silver have peculiarities, right? Gold is considered as a safe haven, limited supply. If you look at like a country like China, for the last 6 months continuous, the central bank of China has been buying gold in its reserves. And gold for last 4 5 thousand years has been a reserve of value or reserve of wealth. And with the kind of you know tensions which are going around in the world, probably it may make sense to have some gold. Now you can have gold in many possible ways. You can have physical gold, jewelry, sovereign gold bonds, gold ETFs, gold funds. I would say that, of course, sovereign gold bonds suit most investors who have a longer term horizon because they have a tax benefit as well as 2.5%. I think they get on an annual investment. But for those who are looking at asset allocation, gold ETFs are also something which will help investors to participate in gold without having to worry about the purity, without having to worry about security. Also, you can invest in very small amounts in gold ETFs. You can buy one units which are less than 200 rupees, less than 100 rupees, depending on which ETF you pick. And so, from an investor standpoint, gold ETFs and silver ETFs also present good opportunities to participate in these two metals. Gold, of course, is a reserve, a safe haven investment, and central banks are buying it. As far as silver is concerned, if you look at the adoption of silver in 4G, 5G technology, in electric vehicles, etc., it's quite interesting if you look at the data. In 2015, I was just looking at the data yesterday. In 2015, if you look at silver demand, I think it was about 50 million ounces of silver demand out of the $440 million, 440 million ounces of silver, which was demand, was from photovoltaic, or that is solar. Today, that number has gone up to 127. That was, I think, in 2022, from 50 million ounces to 127 million ounces. That's a sharp jump. And from 14% to almost 25% of the silver industrial demand is now photovoltaic or solar. As we all know, the demand for solar is going to increase. So, silver as a consumable is going to increase. And last 2 years, that is 2021, 2022, the silver supply has been less than demand. And that is why the silver prices have gone up. Now, silver supply cannot increase indefinitely. It's not like printing of paper. Neither can gold supply increase. So, if you look at the demand for silver and gold, and if it remains strong, then those two metals, which have probably been in a range for the last 12 years, can also act as a good hedge against inflation going ahead. No doubt, in the last 6 months, both gold and silver have gone up very sharply, especially last 3 months when the uncertainty in the world has been strong. So I would advise that you should probably wait for a good entry point, but they also help you in terms of your overall allocation. So just to summarize, Indian equity markets are also buoyant because as an economy, we are the fastest, largest growing economy. We will have the largest middle class, and we'll become the growth engines, or we are the growth engines of the world, possibly. As much as we read it, most of the international investors are looking as India as the growth engine of the world. And if we look at from an equity standpoint, one of the better ways is if you have professionals managing the sector and stock allocation, and that's where mutual funds come in handy. And your starting port of call can be the balanced advantage fund category to start investing. That will also give you access to the right debt papers, because in debt, otherwise, we have limited options that as individuals we can explore. But the right debt papers, be it AAA, AA, or sovereign papers, the fund management team at a mutual fund can pick up the right papers for you in the right proportion and allow you within the balance advantage fund category also to participate. There are specific categories in debt also, like the credit risk category, like the bond category, but in balance advantage fund, you get the exposure to both equity, debt, and there is some amount of arbitrage. With equity taxation, you get the benefit of that. So, gold and silver, as I've already explained, international investing is probably getting popular in India, but at this juncture, I would say that there are too many uncertainties for which you need to probably be careful. The moral of the story is that one, asset allocation is important. Two, so don't forget rule number three, which is asset allocation is key. Rule number two, again, don't forget that you cannot invest in something which has given reasonably high return in the last 2 3 years, because following the herd can hurt you meaningfully. And we've seen that many instances in the past, right? You've seen many instances in the past that in 2000, those who invested in technology got hurt. In 2008, those who invested in real estate and power got hurt. In 2021, if you invested in technology and in internationally savvy technology names, you got hurt. So don't invest in trends where the returns have been very sharp and very high, because you can hurt yourself. And most important is, don't invest in something which you don't understand. It is your hard earned money, your hard earned bonus. Invest in that what you like, what you understand. Spend some time in understanding, and that's where having the right advisor will help you. And last but not the least, which is rule number one, don't forget, whenever you are investing, have a long term view as long as you can, and you will see the power of compounding. Most people, if you see, uh, it's not out of nothing that people generally in their late 40s, early 50s are wealthy, and as they grow older, they become richer, right? So you will find that large part of wealth is in people who are in their 50s, 60s, because they've invested and allowed their money to grow, right? Be it in business or in mutual funds or otherwise. And that's where, if you look at yourself also, these three simple principles. One is, give your money time to grow. That is patience for the long term. That's rule number one. Um, Rule number two, do not invest in something which has gone up too sharply. Most people make this mistake and lose out, which is basically then difficult to recoup. And third is, invest via asset allocation. The preferred category, of course, is balance advantage fund category. And that will help you to grow your wealth over the next 5, 10, 15 years as India grows. So those are the simple tenets as I see it. Otherwise, commodity investing, etc., is also something which investors do. But I'll stick my focus today on this balance advantage fund as a category for investors. and the first two principles of patience and not following the herd. With that, Rohan bhai, I'll stop and I'll be happy to answer questions. Making money, just one last point, making money out of your bonus is not as difficult as it sounds. Just that don't allow the bonus to be spent on things which you don't need, but invest in something which you will feel will grow over a period of time. And that's where the balance advantage fund category can be that large, chunky investment which you can do. And of course, have SIPs in the flexi cap category, mid cap, small cap, pharma, tech, wherever you feel comfortable, right? Have SIPs in them that will help you to create that necessary alpha in your portfolio. Thank you. Ron bhai, over to you.
Thank you, sir, for giving us your time today and hosting this session with us. Uh, to summarize the session, the three golden rules which Mr. Chintan Haria shared, that invest as long as you can to enjoy the power of compounding. Don't invest in trends; it has a risk of losing capital. And invest in mutual funds via asset allocations. And the starting point could be balanced advantage fund category, which will give you the flavor of investing in mutual funds and create wealth for yourselves. Thank you so much, sir, for joining us. Looking forward to conduct more such sessions with you so that our viewers can understand mutual funds better and create wealth for themselves. Uh, Viewers, if you have any questions for us, please do leave your comments below. We our investment team and researchers will get back to you with the right answers. Looking forward to see you all again in another session. Thank you. Thank you, everyone. Thank you,
Thank
sir.
you. Thank you.